Welcome to the What's Your One More podcast. Today we're going to have our monthly lending update brought to you by our sponsor, Bank of England Mortgage. And with me today, I have my co-host, Mr. Daniel Halverson. Thanks for joining us today.
It's good to be here.
Yeah, so today we're going to talk about our lending update sponsor, Bank of England Mortgage, brings to the table. And, each month it's something different, obviously. But right now we're in a different type of setting. We're in a different type of normality. And we're seeing a lot of people that entered the business in 18, 19, 20, 21, if you may. And it's been nothing but a rise to the top since then. And right now, we're kind of settling into normal. And when I use that word, I think there's really different types of normal for different types of people. What I mean by that is if you've been in the business in the last 4 years, your normal looks different than, say, my normal. I've been doing this for 21 years. You've been doing this for 12 years. Your normal looks different than a 4-year normal. So as we talk about this, one of the things that we want to jump right into in this lending update is kind of the inventory conundrum getting back to normal. And, in those pre-pandemic levels, if you may, not this 2021 level of inventory. So as we get into that, our friends over at Market Distillery have been able to share some information with us. And the first thing we see there is that, it shows that inventory year over year. Now, remember, we're comparing 21 to 22, so that's always dangerous, but it shows that inventory is down 17.5% year over year. You want to talk a little bit about that, Daniel, and kind of what you're seeing in the market with that?
Yeah, so ultimately, I think that the biggest reason that inventory is down, you start at the top down. Really, if you look at household formations, so the Census Bureau publishes that information, and essentially we're creating 1.6 to 1.7 new households per year, and that's basically somebody going out on their own and moving out, finding their own place, or that might be a couple that lives together, splitting up and living separately. But anyway, it ranges somewhere in the 1.6 to 1.7 million households per year.
And when you say creating, you mean like this number that they produce each year? The Census Bureau says, "Hey, listen, we had 1.5 million households last year. Now we're at 1.6."
Correct.
That's kind of how it's gaining.
Correct.
Okay.
And on average, the numbers level out somewhere 1.6 to 1.7.
Okay.
So you've got that many households being formed, and you look at housing completions from the National Association of Builders, and I look at housing completions because housing starts is generally what is used based on permits pulled, and you would presume that those homes ultimately, yes, would be completed, but you don't know the time frame of that. So if you look at housing completions, though, if you total up single family and multi, you've got 1.35 million expected housing completions this year, of which a little bit under 1 million of that is single family homes. So you got 1.7 households that need somewhere to live. You got 1 million completed residences for them to go to.
Right, because when we take the multifamilies out and we take out the apartments and things of that nature, we got 1 million single families.
1 million single
And
families.
now we got 1.7 million people looking for a home. It doesn't take long to do the math. We're about 700,000 short right now.
Yeah, and so you start at the top down. That's the top. But now you also look at, you've got this situation where the mobility rate of sellers, of people wanting to go somewhere and buy a new home, is much lower because they've presumably got a sub 3.5% interest rate. So their motivation to go from home A to home B is now much lower. And that is also putting a drag on the amount of inventory that's out there. So I think that's an interesting point as well, that interest rates are also kind of driving that.
Yeah, and I think it's interesting. We should talk about mobility rate because in 2018, we kind of saw that term surface a little bit. Then it dissipated really fast in the first quarter of 2019. But it really is playing a factor right now because over the course of the last really 9 months, that mobility rate is that what we mean by that is that transfer rate from the seller. The seller who currently has a rate at 2.75 to, let's say, 3.5, heck, even 4 right now, that the cost for them to move into a home today, they can't transfer that rate with them. So there's no mobility in that rate, and that's why we refer to it as a mobility rate, because that may be actually keeping them in that home longer than they would normally be because of the affordability of maybe buying another home at 6% plus.
Yeah, I mean, 100% accurate.
So when we take a look at that, that's one of the things that's causing that inventory to be at 17.5, combined with the other, the Census Bureau numbers that you mentioned, as well as the National Association of Home Builders numbers. And when we put all that together, it creates an inventory problem moving forward. And it's a simple supply and demand feature here, because we have 700,000 people that are going to be looking for a home that are short for a home. And you might not have a bidding war, you might not have a price war, But what you're going to have is an inventory war at some capacity getting ready to happen.
Absolutely. And as far as if you're looking at it as a buyer that wants to buy a home, obviously interest rates are a concern right now.
Hmm.
And I think that a lot of buyers mentally, their thought process would be, I'm going to wait and see if these interest rates push home prices down to a point where I can afford it, or where I'm more comfortable, even if maybe I can't afford it right now, where I'm more comfortable. And if inventory continues to be a problem, well, home prices are going to continue to go up, albeit at a slower rate, because interest rates certainly bring that number down. But to think that home prices are going to go down when there's this significant undersupply of housing, it doesn't add up. So, I think as a buyer, and that kind of leads into a little bit. One of the other things that we talked about, there was an article that came out, a national news article that came out about buyers settling in, was the word they used.
I
Settling
saw that. I think that was
into,
from Bloomberg.
correct. So settling into the higher rates, and the logic being, a lot of buyers are realizing, hey, maybe I should buy the home now and not find myself in a position where a year from now I'm still paying 5, 6, 7% more for that home, and hope to refinance later with all the speculation, I guess you could call it, that interest rates will come down maybe over the course of the next 12 to 18 months. And I really think that that's the mindset that a lot of buyers should have. If you can make it work right now, ultimately you might find yourself in a position a year from now where prices are higher. If rates are still higher, you're in a worse position. But the other kind of the bigger thing that I think that is something that maybe a lot of people are not considering is, imagine if you've got this market with extremely tight inventory, prices are still kind of going up, and then rates do come down to that 4.5% that Fannie Mae
Yes.
says. And then do we have another situation, maybe at a less severe level, but do we have another situation where we're back to bidding wars and the inventory is still a problem, but now people can afford more, so they're willing to pay more. So I think it's just an interesting discussion. And it begs the question as a buyer, are you indeed better off trying to buy a home right now and then refinancing in the future?
I heard the commentary about the cost to wait. And I think it was something like, rates may be, and I'm going to exaggerate here, 7% today. Yeah, you're going to pay 7%, but you're paying 100% interest on that rent if you decide to rent. Because there's nothing being built there. And oftentimes I think there's a disparity with our buyers in today's market, that they've really been taught the idea that buying a home is an investment. Well, if it's your primary residence, that's kind of a false pretense there, that you should really look at that as more as not so much an asset. And I know that sounds crazy, but it's not your asset. Asset would be an investment vehicle for real estate, a rental home, a commercial property. That's going to be your asset. This is a place you live in that it may or may not go up. But we've been so, how can I say it? For so many years, we've been programmed that you're buying this and it's going to be an investment. It's going to raise in equity. The cost is going to go up. And over the last couple of years, we've seen this double-digit plus increase. So now these waves of buyers and people that have refinanced, and even that bought and sold multiple times that 2 years, are programmed to get these large returns, when in fact real estate standard appreciation is 4%. But right now we're seeing 20 in some cases. Well, not right now, but in the last 2 years, 20 plus a year. And so buyers want to continue to keep seeing that, right? And it's not stable. It's not going to happen.
And I think that the context, the narrative is, well, home prices are falling. Well, not really. Home prices are still going up, at least in our market. I can't speak to every market. Home prices are still going up, just not at the same clip that they were. And you call it something different as far as the cycle that we're in right now. I kind of tend to refer to it more as the acceptance phase.
Sure.
Where we're at right now, buyers have to accept where interest rates are. Sellers have to accept that they're not maybe going to get 13 offers and someone bidding $50,000, $60,000, $70,000 over ask. So,
yeah, I think we call it the resetting expectations phase, but it's all the same, and it's exactly what it is. They're having to accept where they are in the market right now.
So the resetting of expectations is people are saying, okay, well, home prices are falling. Well, home prices are really not falling, and there's really still not at this point, from any of the data that we see, any compelling reason to think that home prices are going to fall to a point where affordability will significantly improve for buyers. The only way that affordability will significantly improve is via interest rates.
That's
because
the catalyst every time.
wages can't go up fast enough. Prices can't come down fast enough. Interest rates are really the only thing that are going to significantly move the needle on affordability.
Right. And while we can't forecast, or excuse me, predict interest rates, we can forecast them. And, you know, and our friend Alex Stewart over at the Market Distillery Report, one of the things we've learned through that report is that in cycles like this, when the Fed raises the rates, the short-term interest rates as fast as they have, there's a probability, and a high one at that, that the recipient of that is lower interest rates in due time. And to your point, as those rates start to come back down, the affordability is going to get more increasingly, which means when rates come down, the seller always raises the price. Always. And it's usually about a 2-week to 30-day cycle. It's like, oh, well, buyers can afford more, raise the price. And so to your point, maybe getting in something now where you have a little bit more leverage. You want to talk about the buyer's leverage right now? Because that was something in the pre-show you were telling me about that I thought was really interesting.
Yeah, and just kind of bring it all home here as far as a buyer. So we talked about inventory, we talked about settling into interest rates, but the biggest takeaway from me that I'm seeing in the market right now is that buyers have more negotiating power than they've had since 3-4 years ago. The days of multiple offers and you give the seller whatever you want, you give them as long as they want or as fast as they want. You waive every contingency. So, those days are gone. More than half of the home builders are back to incentivizing buyers via, closing costs,
all-purpose cash,
rate buy downs, exactly, flex money, however they wanted to use it. That's coming back. We're seeing a lot more sellers agreeing to concessions, and we're actually working on grabbing the data from 2017 to current across all of our loan applications to see if we can quantify exactly what the increase has been from 2021 to now 22 in terms of how much the sellers are willing to contribute. But as a buyer, you've got a lot more opportunity to find value in this market in terms of negotiations. And then you think about that in terms of if I'm able to negotiate what at the time is a pretty good deal, and Fannie Mae's right, and interest rates go down to 4.5%. Well, now I'm sitting on a really good deal instead of waiting on the sidelines and maybe finding myself in a position where I'm paying more for the same home, and I'm in a bidding war a year from now if interest rates do fall.
So as we kind of wrap up here, a couple of things to think about. I want to tackle one topic before we actually wrap it up. You were mentioning earlier in the pre-show, and I would be remiss if I didn't say this, little caution in the wind over some of these loan amounts that we're seeing out there right now. And I think what you were mentioning was that the standard conventional loan limit right now is about $647,200. Now, in COVID, there was this excitement level amongst lenders to jump the gun. Normally in November, mid-level of November, mid-month, we get an announcement every year of what the new FHFA loan limit is going to be for conventional loan limit, and then FHA follows about a month later. And starting back last year, people were jumping the gun early, and let's say like in July, September, around that time frame in there, jumping the gun, giving new loan amounts. They did the same thing this year, but we've kind of have some caution in the wind with that if you want to talk to it a little bit.
Historically, at least the 12 years that I've been in the business, the FHFA, they come out and they announce the new loan limits. Fannie Mae announces the new loan limits November, December timeframe, effective for loans closing at the January 1 or beyond. So exactly what the loan limit is at that point. And last year, for the first time, we saw lenders looking at that price index that the FHFA produces and saying, we feel so good that this is going to hit a higher number that we're going to go from the actual loan limit, which was $548,250, to we'll take loans at $625,000 effective now, 3-4 months before January 1.
Yeah, literally guessing.
Yeah, absolutely guessing, and there's obviously a risk element to that if they're wrong. They turned out being, they undershot it because they went up almost 100,000. They went up to 647,200.
Right.
But this year, for the first time, that index in July showed prices maybe stabilizing a little bit more. There wasn't an increase like we're used to seeing. But a lot of lenders have already gone out and said, okay, we're comfortable going from 647 all the way up to 715. We'll take your $715,000 loans now because we're confident that those prices are that price index will support those higher loan limits. But it'll be interesting to see over the next couple of months. That data lags a little bit, but once we get August and September, it'd be interesting to see if those prices continue to show stabilization. Does that mean that they're going to roll back those 715s before January 1? So it's just kind of an interesting thing to keep an eye on to see if some lenders get caught. I hate to say get caught with their pants down, but get caught trying to offer something and then having to roll it back and really being in a situation where they've got loans, that they can't offload to the agencies because they jumped the gun.
Yeah, and for our audience, the FHFA is the Federal Housing Finance Agency. They determine all the Fannie Mae, Freddie Mac loan limits and governing body for them. And to Daniel's point, I think it's interesting because it's not going to impact the borrower. I mean, the borrower's got the loan done, but it could impact the servicer, which could be a trickle-down effect. And it'll just be interesting to see how that plays out from here. I think it's definitely something worth watching. As we bring this together for our audience, some advice that I think we can offer here that's really interesting is, we're in a different market. We're in a normal market. And for people that haven't experienced this, maybe just take a breath. Just take a breath, deep breath here, that this is normal. And we go back to 2017, 18, this was every day. This is normal. And then, we can't control what we can't control. You can't control interest rates. You can't control the economy. You can't control inflation, but you can control your thoughts and the way you prep for your business, what you do, right? We can't control buyers. We can't control sellers or anything else in between, just our actions. And then last but not least is maybe forget about what happened a year ago. That isn't happening right now. Forget about those multiple offers.
100%.
6 days, 6 hours on the market, 20 offers. That is not happening. Forget about that. It's kind of like the people that survived 5, 6, 7 and rolled into 8, 9, all the way to 15. You got to quit saying, I remember back in 2003, 2004. You got to quit saying, I remember a year ago, or I remember 10 months ago. You got to let that go, because that's not the market that we're in right now. And it's probably not going to be the market that we're in until we get on the other side of May to March.
I think you nailed
March
it.
to May.
I think you nailed it. And as a buyer, I know we've reiterated this a little bit, but as a buyer, you've got to understand that there is value in the market right now. And interest rates are not what you want them to be. They're certainly not what we want them to be. But there's opportunity and there's value out there. And if you're an agent, find those customers that understand that.
Great point. Great point. Well, Daniel, I can't thank you enough for being on the show. The lending update's always fantastic. We'll continue to do this monthly. I'm your host, Quentin Harris. Thank you to our sponsor, Bank of England Mortgage. And thank you for being on the show, Daniel. Again, we appreciate it.
Absolutely, man. Thanks for having me.
Absolutely.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.